Let us summarize the module. In this module, we introduce the concept of aggregate demand, a key pillar in understanding macroeconomics. We first introduce the components of AD, namely consumption by individuals on a day-to-day basis, investment by firms in inventory and gross capital formation, expenditure by government in public projects, infrastructure development, and in maintaining sectors exclusively managed by government, and net exports, net effect of exports minus imports in adding to AD. Then we delve into them in details. In order to explain the first component in details, we introduced a character called Shashank, who works in a firm and can be considered to have the usual traits of any consumer. It was established that his expenditure is directly related to his income. The more the income, the higher the expenditure. We introduce two concepts here, A and MPC. A relates to an amount of spending that Shashank would anyways have to incur irrespective of his income. And MPC relates to his propensity to consume given an income level. It was established that his expenditure C is equal to A plus MPC multiplied by Y, where A is equal to autonomous consumption. MPC is marginal propensity to consume. Y is the income. A brief touch was done on how taxes affect his consumption, and it was said that C gets adjusted to C is equal to A plus MPC multiplied by Y minus T when taxes are non-zero. Then, investment was added as a next step. Another character, Mr. Karthik, was introduced to explain the nature of investments. Investments mainly done by firms in three areas: inventory management, fixed assets formation, and expenses done by the firm on an ongoing basis, example salaries. All such expenditures directly add to the AD curve. AD is equal to C plus I is equal to A plus MPC multiplied by Y plus I is equal to A plus I plus MPC multiplied by Y. After that, Keen's cross diagram was introduced that maps the C and I components to the aggregate demand and aggregate output axis. It was established that income Y is equal to AO in the long run, and hence Y can be replaced with AO. In that graph, it was shown how with changes in I, the AD changes. In this module, the concept of equilibrium was also elucidated. This equilibrium point is established when the 45-degree line of the AD and AO graph meet with the AD function. This is the point where the AD is equal to AO, namely the total economy output is at the same level as the total economy demand, and hence the equilibrium point. It was established that depending on the nature of the C and I function, there always would be an equilibrium point where the AD would be equal to AO and where the economy would tend to arrive at. Subsequently, the concept of expenditure multiplier was introduced that captures how AD moves when I changes. This multiplier in the example was 2, that is, with a $1 change in I, the AD change was 2. Intuitively, it was explained that this order of change in AD owing to a change in I was due to the money being spent on expenditure other than pure investment that needs to be done to sustain the investment. Examples here were salaries of additional people to sustain the gross block addition. This was calculated as 1 divided by 1 minus MPC. It was then shown that the same expenditure multiplier can be used to see the response of changes in autonomous expenditure A in AD or AO. The susceptibility AD to C and I were demonstrated through the expenditure multiplier. In slide 7, government expenditure was introduced and its two tools, namely taxes and public spending, were described in details. Any increase in taxes reduces AD by MPC multiplied by T, indirectly through either changes in C or I. This indirect relation is because as taxes increase, the propensity of individuals or firms to do expenditure also decreases. Role of net exports in triggering AD was taken up last, and it was described that as NX increases, there is a proportional increase in AD. In the last, the changes in AD owing to changes in any of the AD components was summarized. AD is directly proportional to changes in autonomous investment, consumption, government spending and net exports. AD is indirectly proportional to changes in tax rates.